Welcome back to Blockstream Talk. For today's conversation, Blockstream CEO and co-founder Dr. Adam Back joins us for a review of the ongoing meltdown at FTX and Alameda Research. Adam has a wealth of knowledge and market context I think offers a unique perspective when you try and figure out what has happened so far, how things could evolve going forward, what are the key lessons for users and investors, and how what happened at Alameda and FTX matches up to previous blowups. If you find this conversation useful, don't forget to like, subscribe, and share. Adam, welcome back. Thanks for taking the time to do this today.
Yeah, thanks for having me back.
So I was just thinking the last time you were on the podcast was in June or July, just after Luna. And 5 or 6 months later, here we are again.
Right. Different and yet similar events with FTX.
So before we start, maybe it's helpful to try and summarize and quickly go through what we think has happened so far and where we are at the moment. So SBF founded Alameda Research in 2017 after leaving Jane Street, which is a big TradFi prop trading and market making firm. They soon became quite a big trader within the digital asset space. They were the top of the leaderboards at I think a number of the big exchanges. Then in 2019, Sam SBF and Gary Wong, they founded FTX. And 6 months after founding, or within 6 months, Binance emerged as a really big investor. They took a 20% stake in FTX. And then kind of jump forward to 2021, FTX was a real darling of that 2021 bull market. They had a peak valuation of $32 billion and were raising really large tickets from very big, very traditional, typically conservative investors. And then fast forward to, what's happened in the last couple of weeks. I think things really started to heat up maybe 2 or 3 weeks ago when news began to circulate that FTX and Alameda were having financial troubles. And a portion of their balance sheet, of Alameda's balance sheet, was leaked out, showing a pretty big gap for the firm as a whole, I think, implied a pretty big gap for the group as a whole between just assets and liabilities. And then in parallel, SBF was also lobbying US policymakers and regulators for more aggressive crypto regulation. And I think what happened was that CZ from Binance apparently felt like he was getting thrown under the bus, the regulatory bus in that process. And he announced on Twitter that he intended to sell a very large position of FTX's FTT tokens. And this triggered both a bank run on FTX and crashed the FTT token price, which appears to have been used as collateral against user holdings on FTX and possibly with other external entities. So FTX then quickly shut down withdrawals. Binance came out and offered to buy the company out, but then backed out within 24 hours. Alameda looked to have continued trading for at least a couple of days, which I think is pretty odd.
FTX, you mean?
No, I think it was Alameda who was trading afterwards.
Oh, okay, both then.
I'm not sure. Yeah, so we should throw a caveat in here that a lot of this is very uncertain, and we're trying to piece it together as best we can. So then SBF came out and said that the assets with FTX US were fine, and then reversed on that pretty quickly and shut down withdrawals for that entities as well. They've now declared bankruptcy. What's left of their balance sheet is now frozen, though at one point, I think they were allowing withdrawals for Bahamian residents of the Bahamas. And on top of all of that, there appears to have been a fairly large hack in the hundreds of millions, and even reports of malware being attached to FTX app updates. So there's a lot there, and it's just more stuff coming out every day, and it's a little bit difficult to summarize. But does that sound about right to you, Adam?
Yeah, heard all those things. I think that clearly what was visible was, while the exchange was operating, people could log into it. They could trade, even though on both FTX US and FTX International, and logins were working, but that stopped as of a couple of days ago. Though curiously, there are, live ticker prices on some assets which are tracking other exchanges, I think. Well, I don't know. The website seems kind of flaky. I just tried it now. So I'm not sure. But yeah, I think it's not operational. People can't trade on it.
I guess the first question is, so the bankruptcy thing is relatively recent. Do you think that was the right way to go? Because as soon as you get tied up in that, it just takes forever, right? So Mt. Gox is still ongoing. And with Quadriga, just a huge amount of money of what's left, what's recovered, gets eaten up by trustees, auditors, lawyers, accountants. So is bankruptcy the right way to go, or should they have tried to do maybe a recovery token, a debt token of some kind?
Yeah, that's an interesting question. I mean, maybe just first to briefly recap the scale of the losses, and now, of course, we don't know exactly how. I mean, the losses seem to have been incurred by Alameda, the prop trading firm. So I think one of the, and I think the other point is, people will, after something goes wrong, people will pop up and say, oh, I knew that was problem all along. But often they didn't, and they're just, talking up their expertise or insight or something. But, in this case, I think, most people didn't see it coming because there were lots of hallmarks of market success, like high volume on FTX, lots of large investments. They bought 600 odd million of Robinhood, made noises about potentially buying Robinhood outright. SBF, Sam Bankman-Fried, contacted Elon Musk, and you can see this in the court documents released by the Twitter legal dispute before that was resolved, showing Elon Musk talking about raising the money with various people. And so SBF was trying to get his foot in the door to be able to buy $3 billion of the Twitter billion raised. So, he had, and I think it was, somewhat real, like he had large amounts of money to play with between the balance sheets or leverage of both those institutions. So, and there's a picture somewhere showing all of the investments of FTX, and it's dozens and dozens of startups. They also bought, I don't know, probably $400 or $500 million worth of real estate, corporate and corporate housing and offices and stuff like that, as well as big, high-profile sports deals. So, the indications of sort of success were there, though I think one of the concerns that was more widespread, and certainly one that I had and why I never, looked to trade on that platform historically, is that there's a kind of structural ownership problem here, which is you have a prop trading shop, which is, kind of hedge fund with its own assets mixed with hedge fund client assets who are extremely risk on and know they're risk on, so that's fine, doing risk-free leverage trade in the market and predatory trades and things like that. And then that entity, which claims to have been successful, starts an exchange and operates an exchange under effectively the same or similar ownership. And so the natural worry there is that this hedge fund is breaching the Chinese wall, i.e. looking at exchange clients' positions, like their stop losses, their leverage ratios, their capital to be able to protect stop losses. And, armed with that information, anybody can make a ridiculous amount of money if you have no ethics. And that's why there are rules against breaching Chinese walls in exchanges, right? And so because it's under same ownership, that is an elevated risk. And so, that was a suspicion for me. So successful or not, solvent or not, and the indications were it was successful and it was very solvent. But I wouldn't touch that trading platform with any stop losses or leverage trading whatsoever because of that. but certainly wasn't on my bingo cards that it would suddenly become illiquid.
It was exactly to me like Citadel and Robinhood and all kind of the criticism that came out of that, except much worse because it was completely internalized. And, you know, I heard on the All In podcast, they were describing it as online poker in God mode, where you can see everybody's hand. I thought that was a fairly good description of it. You know, and then just trading a millisecond faster than everyone else.
The Fortress Robinhood is, I don't know the full ins and outs of it, but I think it's they clear the trades, and so they get, you know, a few milliseconds of preview of the trade to stand in front and execute the trade. And so they may not make much per the trade, but they get fast intelligence on what retail are up to or something. So I don't know how that works, but I'm supposing that they wouldn't have access to total position sizes and liquidation levels. So in a sense, you know, it's intelligence, but it's not, you know, an incredible advantage, though it's something that high frequency trading and hedge funds often try to do. Like Fortress are not the only ones that try to get, so it's a common strategy for high frequency to get the deal flow information. But here with FTX, you know, assuming that the Chinese firewall was not respected, which is what everybody was suspecting, then they literally have God mode. You know, they can do a calculation, see that there's on average, you know, $1 billion that'll be liquidated below this price. They can look at the market depth and calculate they can spend 200 million to flash crash the price of some illiquid token. Below that, take a margin long position somewhere else and, you know, calculate their profit. And, you know, that's much easier on, you know, illiquid assets than on Bitcoin, because arbitrage will sort of keep that in line between exchanges. They're apparently also market making. So Alameda was market making heavily on FTX and probably other platforms. That was part of the story of how they grew, that they were doing market making. And you can make money on market making, but you can also lose money on market making. So we don't know if they're actually profitable or not ultimately on that activity. And so, you know, then fast forward to the, you know, the unwinding events that you described at the beginning. It seems that at this point, Alameda, well, the combination, at least FTX has a 10 billion hole, and that somewhere along the way, FTX had somehow put at risk client funds, because a normal exchange is just, you know, ring fencing and storing client funds in cold and hot wallets and not taking any prop risk on client funds. So we don't know exactly how that happened. There are lots of, you know, possible scenarios ranging from, you know, I think it's easy for people to get angry and, you know, infer just outright theft or something, right? Or you know, gambling, you know, taking leverage long positions with client funds or something like that. But there are also more slippery slope situations, or, you know, having suffered a big loss, you know, for example, the Luna loss. Some people are speculating that Alameda lost billions in there and has been slowly trying to dig their way out of it until they get hit with this liquidation. With the bank run, the 5 billion of user withdrawals until they ran out of liquidity. Because their initial story, before it unwound further, was that they had to pause withdrawals because they were short of liquidity, i.e. they had the client funds or enough assets to bank the client funds, but they were illiquid, so they couldn't withdraw that fast. And there was a comment that, you know, they looked at historic average daily withdrawals, and it was, you know, so many 100 million, and they had, you know, some multiple of that, maybe 10, 20x or something, but this withdrawal was off the charts, right? Because people were panicked. And so, you know, the initial story was stay calm, fund safe. We have the money, but just not liquid enough. So we have a liquidity crunch rather than a solvency crunch. And, you know, some people were pointing out potential discrepancies in the leaked Alameda. So Coindesk, as you mentioned, leaked statement of Alameda's position. And so the CEO of Alameda is distinct from the CEO of FTX, Caroline, somebody, tweeted that they have another 10 billion of liquidity that's not shown there, or of assets that are not shown there. And so that was to try and calm the market. And in the meantime, Sam Bankman-Fried was trying to raise money, culminating in the, and I presume it's still ongoing, possibly, but CZ from Binance looking at the books and deciding he ultimately wouldn't invest. So now, in terms of the most benign version of what could have gone wrong, which is still, unethical and probably illegal, is that I think if you look at comparisons of how different markets are structured, it's very common for share brokerages to have in the fine print that they're allowed to lend out client funds to collect an interest, right? So if you look in E-Trade or Ameritrade or any of these guys, and bigger guys, it's not just retail, it's like bigger brokerages as well. They have the right to lend your shares to people who are short the share or something like that, and the interest goes to the brokerage, not to you, the customer. And from that they would, those are typically more liquid, so presumably they have some shares available to sell. And if a lot of people try to sell the shares at once, they would have to buy them back, basically. But that they're lending the share, so the share didn't get sold prop or a prop trading position, but at least the lending is within scope if the fine print says it, at least for shares. Now, for exchanges, people don't like that. Now, there might be other exchanges that are doing this, and I think I've heard rumors of this practice occurring, particularly with dollar balances, that exchanges would offer zero commission and lend out the balances as a revenue model, basically lend out the dollars on some kind of margin lending or other yield instrument. And there are yield instruments for Bitcoin and altcoins, but those have a higher risk profile. They're typically in DeFi because the natural market rate for secured lending of Bitcoin is probably 0.5% or below, whereas the market rate for margin lending Bitcoin dollars is 10% or more, right? So now, how? Now you would there's something else puzzling, which is between Alameda and FTX, they had a lot of FTT tokens. So to explain what they are, they're an exchange token. Many exchanges have them. It's some kind of it's not exactly an altcoin. It's more like a share or something. So it's some kind of structured share product, and what it is basically is a combination between a dividend and a share buyback. So they commit to using on a frequent basis, like maybe daily or monthly, their revenue from the exchange operations, like trading commissions from the exchange, a percentage of it, maybe 30% in FTX's FTT case, 30% of commission revenue from the exchange, to buy back FTT tokens on the market and burn them. So that is effectively like a share buyback. And of course, if they're making a lot of, if they start to make more money, the buybacks will escalate and it will push the FTT price up, and people will look at the kind of growth metric and assume it's worth more. And so I think those are, people get very kind of anti-altcoin, and I think that is more like a share. It's a very specific kind of unusual type of share, but it's still like a share interest, right? You don't own it.
And you get trading discounts and things like that.
Yeah, you get extra perks, but I mean, you don't own a share of the business, but you own a share of the revenue stream of the business. And so it's a securitized revenue sharing agreement. And you can also look at it as a commitment to use a daily dividend to buy back shares. And share buybacks are something that companies do when they feel their shares are underpriced. The other context is they created a lot of these, right? And they own most of them. Billions of dollars worth at the price before this event. a few weeks ago. So, going back a few weeks, the price would be in the billions. And those were, even though there were VC investors, large, high-profile investors in FTX, much of the FTT was owned by Alameda. So it's kind of like a second share class that is, funneling profits out to, another entity that's probably also a shareholder, but it's come to their benefit. So of course, these professional investors knew about that and they signed up for it. So that's their formula to choose. But these FTT tokens are being used on the exchange. So FTX has got a lot of leverage products and cross collateral, meaning you can put a bag of altcoins and Bitcoin and dollars into a basket and then use that as collateral to leverage trade other things. So you could buy Bitcoin with it. You could buy, 2x leverage Bitcoin or 20% leverage Bitcoin or 100x leverage Bitcoin. It's obviously crazy, but you could do it. And so the assumption here is that Alameda was using a bag of cross collateral, including an enormous amount of FTT. Now, normally what the exchanges do when they do this kind of leverage trading cross collateral is as the individual traders position, their collateral position is larger. Sorry, it's the leverage positions are larger, and they will downrate the LTV, like the maximum margin you can get against this. So it might start at 99% and it will drop 70, 60, 50, 40 as the position size grows, and that's so that if they are forced to liquidate an individual trader's position and it's big, they won't end up suffering a loss on the exchange if there's slippage. If somebody market sells 500 Bitcoin, it'll push the price, right? So they will give it a bigger haircut if that's going to happen. So the assumption is that Alameda is using this on the exchange and FTT is not liquid enough for the size they're using, right? So that's a risk, and they're using the God mode assumption. They are probably giving themselves, no haircut and possibly no hard liquidation, only soft liquidation, like Roger Ver infamously had on, was it CoinFlex? Just check that. Don't want to accuse the wrong person, wrong company. Yes, CoinFlex. So they may have had no hard liquidation, any soft liquidation, and they may have also thrown in other things like real estate, shares in the dozens and dozens of companies as, kind of nominal collateral or pledge collateral to give themselves an enormous, collateral base on FTX to take out tens of billions of worth of positions, right? Which could be directional. Now, so of course, when the events of last week started, the FTT plummeted because people would assume that if the exchange is suffering problems, the exchange revenue is going to drop. And furthermore, CZ from Binance had said that he would sell 500 million. So people were trying to sell before that hit the market, assuming it hadn't happened yet. And so their collateral was shrinking rapidly, right? So I think that's part of the problem that left the hole. Now, another thing is, if so far nothing in that story explains why client funds are missing. If they were putting FTT and other Alameda assets on the exchange, liquid and illiquid, with high leverage, there's no reason for the client funds to be missing. Why? They could trade in enormous positions with leverage. They could open 100 billion position on 10 billion of illiquid assets with 10x leverage easily, right? And diversified in different things, different directions. So they had no reason to take, nominally, no reason to take client funds off of the exchange. And so when they say that they transferred client funds to Alameda, I think that would presumably be in the exchange, right? So it should still be in the exchange. But they're saying the rumors are that that's not the case, that the client funds are missing. So then the other way that client funds could be missing would be if they needed to transfer something real, like dollars, or by a wire transfer or Bitcoin to another party, like an institutional lender, who wouldn't accept illiquid things like real estate or FTT tokens. So one possibility is that they, had a large FTT position and needed to spend $1 billion on something real, like investments in companies, loans, political campaign donations, real estate purchases, things that require real assets, real dollars, real money. And so then, they could buy dollars using FTT as collateral on their exchange, but they might also have transferred, let's say, client Bitcoin to, an institutional lender and borrowed against it, with the rationale in their mind that, the Bitcoin was still there, they were as collateral, and there was FTT to collateralize it, which is very dubious. So that seems pretty very bad if that's what they did. Another softer version of that is there's a thing called SOBTC, which is a Solana wrapped Bitcoin. So there are various wrapped Bitcoins. There's wrapped Bitcoin on Ethereum.
16,000 of those, I think, on Solana.
That's right, 16,000 Bitcoin in SO Bitcoin at today's price.
SOL.
Yeah, 300 million almost. But, going back a week ago, that would be 300 million. So I suppose it's not very much on the scale, but it shows you that things like that can sort of put a wrapper of assumed legitimacy around something, because people are busy trading with SOBTC, assuming that the BTC under it are cold stored somewhere, where actually I think that is, Solana is very closely tied to FTX and Alameda. So I think what people are saying is that the Bitcoin were actually managed by FTX. And so they may have been swept along with client funds in whatever went wrong. So, potentially nobody. So now they've filed for Chapter 11 bankruptcy. So Chapter 11 is a little bit short of like an insolvent bankruptcy. It's a chance. It buys. I'm far from an expert on this, but my limited understanding is it buys time to give protection from creditors so that they can raise money and restructure, like sell business units, sell assets that are less liquid, and bring in new investors, maybe change management. So there is a process for Chapter 11 where companies can come out of bankruptcy, and this does happen. But so that was their starting point, and Sam Bankman-Fried has resigned. There is a new CEO appointed by the bankruptcy court in the US, who is, curiously enough, the guy who was the Enron bankruptcy manager. So somebody with a lot of experience in a complicated, large bankruptcy.
Circling back to, bankruptcy versus the recovery debt token, I was wondering, if they're trying to do bankruptcy just to buy time to restructure things, has there not been just too much reputational damage and betrayed trust? I wonder if that's even a possibility in the exchange business.
I think in a conventional bankruptcy, the brand is now impaired. I think it got worse over the last few days, probably, so that it's less plausible to resurrect the brand. But I think that, if that, what the bankruptcy would do if it goes to a different level is they would, forensically analyze the situation, try to carefully liquidate all assets to the benefit of the people with funds, creditors, and disperse it over time. Now, the unfortunate thing with bankruptcies is they're expensive. Like, they use up hundreds of thousands of hours of, very expensive legal and accounting firm fees, and people don't get their money back, any of it back for, in the Mt. Gox case, it's been, 8 years and counting. So Then you get to the recovery rights token model, which is something that Bitfinex did a very long time ago due to a very different circumstance, which was an external hack where somebody stole some client funds from storage, somehow involving BitGo's security solution. So it's not too clear what exactly happened because it was a hack, but in any case, there wasn't a kind of breach of trust element, right? And so what they did is very interesting and innovative, I think, and ultimately a success story and potential alternative to bankruptcy, which is they put so they took a snapshot, and that's the assets at this point, and then they haircut everyone pro rata on what assets were left, and then they gave everybody dollar-denominated recovery tokens for the dollar-valued shortfall from that snapshot. And then they committed that they would assign a certain portion of revenue to buying back these revenue rights. So the people holding the revenue rights had a few choices. They could convert them into shares in Bitfinex, they could sell them on the market, or they could hold onto them. And if they held onto them, they would slowly buy them back or make them whole over time by committing a portion of exchange revenue to pay them down. And if the coins were later recovered, with the involvement of law enforcement, if some of the coins were recovered, they would go to these token holders. And so the advantage of that is it was fast, and people got access to some of their money very immediately. And clearly for most people, that is highly preferable because for individuals, if they are, like, look at the FTX case, right? If they are 90% in FTX because they were making use of the yield product or trading or too much or something, now if they don't get access to any of their funds, they probably have to sell property and move back in with their parents, like complete lifestyle change, rethink everything. If they're a company and they had all of the company funds in there, maybe the company is bankrupt, they have to wind the company down, even though the company was fine otherwise. So it's really bad. Whereas, let's say the level of cash left was 20% with a possibility of another 20% within a year with careful liquidation of illiquid assets and a possibility of the rest, over time, 5 years later or something. That's preferable. In this case, even so, I would say even if the exchange has lost its brand, you could do the first parts of it, right? Which is you could give people immediate access to what's left. You could sell the illiquid assets in an orderly fashion, getting better prices for them without fire sales, and pay those out over time. And companies and individuals could work with that because there's a plan there, right? So they, maybe they've taken a 50% haircut, but they're not bankrupt. They get 25% of their money. They can use it for a year or two. They get another 25% over as things are liquidated in an orderly fashion. And maybe it's not so plausible that the exchange could pay back from revenue because people lost confidence in the brand, let's say. So I think even that is still preferable. So anyway, they've now filed for Chapter 11. So I think it's out of that. And so now we're just left with, a slower push situation where I think typically you don't get anything back until they've completed the forensic accounting. And it's going to be very complicated and slow because it's an enormous business with literally hundreds of sub-companies.
Yeah, I think that's also assuming that there was no fraud involved. If they were, flat out using client assets inappropriately or, really at all, then I don't think it's, you can't just issue a token and walk away from that. I think that's going to be a lot more difficult to kind of go that model than being forced down bankruptcy and a much more kind of painful path.
The path to the revenue rights model, so far, the main precedent we had that worked really well, I would say, is the Bitfinex one, Now, in this case, so I don't think we've had a precedent that looks like this case with FTX, where the operators have lost trust. And I think it could still be possible, in principle, you'd find another trustworthy player. And I discussed with some people, like, is there a candidate who could step up? Somebody who's a trustworthy exchange operator, or somebody who has experience operating exchange who could step in, fire, remove anybody with a suspicion of trust, like all the top management, everything, and operate it not to reboot the brand, but to provide immediate liquidity and slowly liquidate the assets. So I think that could have been done, but it might have been difficult to do it because FTX had made so much noise with regulators. They'd cozied up to regulators, made major campaign contributions to, the current US president. There are photos now deleted of FTX, meet and greets with top tier regulators. So he'd made so much noise that if somebody had tried to do that, it may have been difficult because the regulators might have gone international in that context, right? So at the time, and it may be more difficult, it may be a different era as well, because at the time Bitfinex did this token, there was less onshore regulation available and more ambiguity. So, but nevertheless, I think it's an innovation that countries should consider. Maybe some countries that provide exchange operations could put it into their bankruptcy rules even, right? But anyway, I think it's probably out of scope now because FTX management are out of the picture. They've handed over their reins of control to the Chapter 11 restructuring bankruptcy proceedings. And, maybe in fact it's gone beyond restructuring, and restructuring can mean a lot of things, right? It can mean, from Chapter 11, people can then make bids to buy parts of the business and leave other parts, or to haircut, partly restructure. They can negotiate with the bankruptcy operations courts to buy, let's say, some of the assets and take over the operations of the business, but give all the clients a 80% haircut or something. And if the bankruptcy court considers that's the best offer on the table, they might approve it. The main problem with it is it's pretty slow.
I was thinking that one of the differences between this cycle and kind of previous cycles in terms of exchange events is that all of the big ones of the last, I guess, really, 6 months, I guess, has been, FTX, Alameda, Celsius, BlockFi, Three Arrows, Voyager. All of these ones seem to have been tied to risk management, when all the previous ones were mostly kind of security events, hacks. So I think that's a big difference between the exchange events of this cycle and previous cycles. I don't know which is worse from an ecosystem impact perspective, if having lacks security infrastructure or lacks lacking risk infrastructure is worse. But how do you think this exchange failure matches up to previous ones that you've seen, maybe Mt. Gox or other big ones, Quadriga?
Yeah, it's big because the ecosystem is bigger. It may not be bigger in terms of percentage of Bitcoin or percentage of crypto total market cap, let's say, but it's certainly big. And Quadriga is, what involved fraud, like very, very overt fraud, and also didn't seem to have been seen coming by most people. So, yeah, it's a number of the exchanges have reacted by posting proof of reserve proofs and so on to show that they have key control, like private key control of big swathes of coins that people are assuming match up with their client deposits. Now, most exchanges don't reveal business metrics because it's competitive, right? They don't want to admit that they're smaller than their competitor, or they got less liquidity, or they got less client deposits. So, but nevertheless, some of them are posting them anyway.
Maybe that's a silver lining to this thing, because I remember a few years ago, Trace Mayer used to have proof of keys every year. and push for people to take their assets off of the exchanges, and people would kind of like half-heartedly do it. Probably like 10% of people would do it. But that seemed like a really good practice. And, this is a stress test for the industry right now because everybody is very, very jittery. And there's a lot of people on Twitter screaming fire. So people are finally, figuring out self-custody and trying to take assets off the platform. And I think it's probably, positive longer term. And maybe this is, a practice that people could get used to, and we could resurrect that idea of the Trace Mayer's proof of keys day.
I mean, the proofs are not perfect because, they're periodic. I mean, they could be more real time, but also you don't really know that they line up with the, let's say an exchange proves they control 10,000 Bitcoin, which is probably a relatively small exchange. Now, you don't know if they actually have $20,000, 20,000 Bitcoin of client funds and they've gambled with half of them. And you don't really have a way to know that. But at least, so I think some of the, and usually exchanges are not allocating specific cold storage coins to specific users, right? Because they have to operate from a hot wallet and so on. So it's a step forward. It proves they have some assets left. It seems like it would have exposed things earlier at FTX and Alameda. Of course, Alameda is not going to want to do this because it's operating with prop money, right? And prop strategy. So, they might provide a proof to their investors, but they're not going to provide one publicly typically.
Yeah, it's a little bit like Tether, right? Like the ability to do massive redemptions kind of proves the stability of the whole thing. So if everybody pulls their Bitcoin out at one time, just their ability to fulfill those obligations kind of gives you a little bit more peace of mind that the exchange is, it has the Bitcoin that they have. And that's another thing that I think came up from this is, the worry about Bitcoin rehypothecation and fractional reserve banking that people have often talked about looks to be, like a real thing, like fairly prevalent.
People who have Bitcoin claims against FTX are now fractional, but we don't know if they were sold Bitcoin that didn't exist. I mean, that's another version which hasn't really been much discussed, which is in the Mt. Gox case, there was the Willy bot or something, right? That was claimed to be manipulating the Bitcoin price and buying Bitcoin with fake dollars, like dollars just edited into the order book. Now, I think everybody's assumption is that was not what was going on at FTX because, I think it's just an assumption, but, they had auditors. The mistakes were probably more likely to be trading mistakes and not, and that Wiley bot, of course, we don't know if that was insider or external hacker. So it could have been a security. I mean, Mt. Gox was largely considered to be a security failure, right? Like a hacking incident. So that bot itself might have been another form of hack, or it could have been the management trying to, price manipulate and recover from an error, like a previous hack or other error. So we don't really know, I think, even to this day. But so, yeah, I mean, I think it does highlight that we should be careful about making bold statements about what happened or even check our intuitions about what likely happened, because with somebody God mode and inside an exchange, an enormous number of things could happen that don't even add up, right? Somebody can buy Bitcoin with dollars that don't exist. They can trade with leverage on collateral that doesn't exist, or they can do what evidently they were. That seems very likely that they were doing, which is trading with very illiquid assets as collateral at enormous size. So I think coming back to what happens, the most benign version is that they made a Sol-like token to hold client assets, not Sol itself, not SO Bitcoin itself, but something like that maybe wasn't publicly discussed, and put the client funds inside these wrappers, logically or with tokens. And then then FTX or one of their many entities would have the assets inside it, and the user would have a claim. Because exchanges will often treat indistinguishably wrapped Bitcoin, Bitcoin, Lightning Bitcoin, liquid Bitcoin, RBTC, which is rootstock, and most of those things are real-time auditable, with the exception of possibly wrapped Bitcoin, which is single-party custody. That is BitGo custody, right? So, they could have a version of that where the coins are not cold stored, but this is Alameda or FTX. I assume I think that there's no adverse assumption on BitGo, to be clear. I think they have the wrapped Bitcoin in cold storage. So, and then armed with this situation, FTX, the low risk thing, relatively low risk, that FTX could have done is try to collect yield on their physical client assets, which they could do on another platform, right? So in other words, what they would be doing is trying to make money by lending client assets. And so that would enable them then to say they were solvent but illiquid, because those yield farming platforms, some of them have lockup periods, and you can give it unlock, unstate, give a notice period, and you get the collateral back. So, of course, if the way they generate the interest was to use it as collateral to borrow dollars, then it could become a liquidation risk, and that would be bad. So we don't, that could have happened either, right? But if they just used the asset to get an interest rate on it, that is the most benign version I can concoct for what could have happened. And there are apparently exchanges that used to do that for dollars at least. It was a business model.
For users, what do you think the lessons here are for users?
Well, I mean, my rule of thumb is, like personally, is if you're going to trade, don't put more than 10% of your coins on exchanges in total, like not in one, not in any, right? And that way, if you have a bad streak of trading, or you get rug pulled by an exchange hack, you'll be sad, but you won't be bankrupt. You'll have a 10% haircut. Now, if you lose 50% of the money, you've got a 5% haircut, right? If you take a leverage position, it goes wrong, you still got the bulk of your money. Now, I think yield has a lot to do with this. People got enthusiastic about collecting crypto yield, much of which came from DeFi, which, people have talked about before. It's extremely high risk. It has disguised leverage. Most of it's actually not yield, but altcoin airdrops. So basically, similar to the excesses of the ICO era, DeFi is not really DeFi. It's like, it's actually airdrops and Ponzi thinking, the yield product behind Luna, right? There was a connected yield service that was offering 20% interest. The yield is actually like that. There is a staking token, an airdrop token that has a value because the thing is growing. So they're all like variants of Luna. And so this is where the risk would magnify if they were to lend. So just to restate something I said earlier, the prevailing market rate for dollars on exchanges like margin managed or even over collateralized with HODL HODL, the prevailing market rate for dollars is over 10%. And that sounds high, even in today's slightly elevated yield, dollar return interest rate regime, because fixed income and institutions are scared about exchange risk. Looks like they were right with FTX. And the people inside the ecosystem, like people with Bitcoin who have any dollars, they want to buy Bitcoin, right? So if they see Bitcoin prices down, they want to buy it. And so they're very hesitant to lend out dollars. And so if you are able to borrow dollars, you have to pay them a high interest rate to persuade them to not buy Bitcoin now instead, right? And so that is why you get these 10+% interest rates. So that's the natural interest rate. So maybe the free market interest rate. The conventional market is not really a free market interest rate, right? But the free market interest rate on Bitcoin or on altcoins, where it's collateralized, so you are not making if you make an uncollateralized loan, of course the person you lend it to can lose it. So that where it's collateralized is extremely low, and so it's a kind of red flag. So I think that in that most benign version of what is pure speculation, mind you, of what FTX and Alameda could have been up to, had magnified risk because it would be putting money into DeFi, which has correlated risk. If there's general market fall, something goes wrong with the airdrop, the insiders steal the coins, it can go wrong and you can lose the state's collateral. So I guess eventually we'll get some information about what actually happened, and maybe it was far worse than that. Maybe they just literally dipped into client funds to temporarily paper over losses and lost control or something. And the other open question is, how recent was the failure? Did it date back to previous losses, ongoing market making losses dating back years and years, or a big, one or two event loss, like a big loss in Luna that they tried to slowly dig their way out of? Or I think it's even possible that it all materialized in the last 2 weeks, with over-leveraged positions and correlated collateral. So if, in a way, I mean, Luna was effectively a Ponzi, but apart from that, a lesson is that it's dangerous to use illiquid, correlated asset for collateral, because it can be fun while the price is going up. As soon as the loss of confidence price comes down, the leverage will kill you quickly. I think people don't have a good intuition for how that works.
What about the lessons for investors? We did a podcast with Elise a couple of months ago talking about the differences between, Bitcoin and crypto VC, equity versus token VC. And, it seems like a lot of really big, typically conservative institutional investors, they just straight lined out FTX's 2021 revenues and didn't do much in the way of due diligence. The company didn't seem to, the investors didn't really seem to push for much infrastructure around oversight of the business. I don't think they even had a proper board. So, how does this play out for Bitcoin companies and for investors in the space? And how much blame do you think deserves to be pointed at investors that, it's their job to do due diligence, and it didn't look like they did a great job and ended up torching hundreds of millions, even billions of dollars?
Yeah, I mean, I think a secondary fact is that their own investment helped lend sort of a carefully PR managed brand image, So as FTX's brand image and Alameda's brand image went up, they were able to borrow and raise more money. And they did weird things like, raising 200 odd million from Sequoia, and then I think SBF personally investing 500 million into Sequoia's fund as an LP. So what is that? That is sort of like more getting into people's circles, buying influence, increasing brand, increasing reputation. There's some element of Theranos in there in a way, right? Which is they had extremely high profile board members, former government politicians and so on. So there's something like that going on here. Now in terms of their ability to due diligence that, I think, of course they could have questioned the tokenomics, the FTT token. But generally speaking, and they could have asked for access to books. Probably they did, right? Which, people in the public looking at the media and the success metrics and the volume, I think it was hard to see directly, really.
I heard from Brian Armstrong was that, he said, we run an exchange business where, comparable size. And, he was just kind of surprised that they have so much more cash to splash around than Coinbase did. And he was kind of wondering, well, where are they getting all that cash? And then people would say, well, Alameda Research is a very successful market maker and trading firm. And he's like, okay, well, I guess that kind of explains it maybe. But, there's that they're just appear to have so much more cash than any of their other competitors. So that was possibly, I guess, in hindsight, maybe a red flag.
Yes, but I mean, in terms of execution, like part of exchange success, as somebody who, trades on exchanges myself, is, apart from liquidity and trust, like I want to know who the management are and do I trust them? Have they got a good reputation, etc. in the industry? Which is why I mostly use Bitfinex, actually. But, something that, for other people will drive their adoption to exchanges is their agility on bringing new products to market. And, for what it's worth, FTX was extremely fast and agile in bringing innovative products to market very quickly. So, and that, that as a practical matter, draws customers, and whether or not let's say that Alameda wasn't involved at all, right? Then that could be that could drive growth, basically, right? So they weren't that large, like 300 people, I think, and some of these exchanges like Kraken, I think, is like more than double that. And Bitfinex, as I understand it, is very lean. But like Coinbase is thousands, right?
The American ones, I think, are all well over 1,000. Yeah, like multiple thousands. It becomes, you start to look like a bank.
Yeah, I mean, from that point of view, FTX on paper was a much better business than Coinbase because they were doing more of very fast-paced execution in taking products to market. They appeared to be doing it in a regulated way. They were talking with regulators, and I mean, actually, they got into industry trouble for the way in which they're talking to regulators, which is they were aggressively pushing for regulations that would be punitive in the sense of being anti-innovation, and for sort of more restrictive regulations than even the regulators were asking for, sort of going way above and beyond what anybody else was saying, to the point of basically killing innovation. So I think that annoyed some industry participants. I mean, I was certainly not a fan of it and spoken against it. And I think Eric Voorhees had a debate with SBF, basically complaining about the same factor. And actually,
yeah, that was quite good.
Yeah, and so CZ in his, after he sort of triggered the FTT price collapse, made some comment that he was unhappy about SBF, basically bad mouthing industry players, right? Other industry players, and it's not a clean thing to do. It's a kind of below the belt tactic, and the claim is that FTX was trying to use family connections and establishment players to obtain a stronger regulatory basis than any other kind of monopoly regulatory basis in the US. So I think, Brian, you've got to read what Brian from Coinbase is saying with that in mind too, which is he would view them, before this collapse, as extremely threatening to Coinbase for good reason, because until this unwound, there was every indication that it was much more agile and lean than Coinbase, and it genuinely was, right? The fraud aside, with the headcount or fraud, whatever happened, right? with the headcount and what they were delivering, they were much better executors.
Ironically, it looks like one of the likely, fallouts from this is that we probably will get more stricter regulation out of the U.S. But I wonder, does regulation solve this? Because I do find it kind of strange that some of the most egregious actors of the last 6 months, the guys from Luna, Three Arrows Capitals, they still seem to be walking around enjoying life, and feeling it necessary to share their market views on Twitter. Meanwhile, Bernie Madoff, he died in jail while serving a 150-year sentence. So I wonder is more regulation the answer, or is it just coming back? Is it coming down harder on the people that do things like fraud or lie or steal user funds?
It's almost the opposite, right? In a sense that on paper, and from the regulator's impression, the US regulator's impression up to a couple of weeks ago, FTX was the most regulated and the most regulator overtly friendly and engaged exchange in the US. And so, hence the regulators, many of the individuals employed by the regulators had social media pictures, shaking hands, meet and greet with Sam Bankman-Fried from FTX. And, they had a lot of political connections. Obviously, I think Sam's parents were well connected politically, like law professors and involved in like a super PAC and stuff like that. So he had some kind of family connections, as well as evidently engaging some very clever kind of branding and lobbyists, and whereas Coinbase, it tries to be somewhat licensed, but it's also under SEC investigation, kind of. I mean, somebody did some insider trading on Coinbase, a former employee, front-running coins about to be listed. And part of the SEC complaint against that is accusing Coinbase of listing unregulated securities without having a securities license. And Coinbase is fighting it, right? So, FTX and Sam, up until a couple of weeks ago, would have looked much more reasonable and engaged and conventional than Coinbase, right? So they really went to the opposite extreme. So to say that more regulation is going to solve this, I don't know. Like the most regulated exchange in the space is the one that blew out. So I don't think that's the case. Now, of course, better internal controls, oversight, and separation of prop trading from exchange, yes. Clearly, there's things to be improved. I mean, I think for the crypto industry, effectively what I started Blockstream for was to build decentralized technology, build more functionality on top of Bitcoin layer 2. So, of course, since Blockstream started, Lightning was invented and developed by multiple companies. But there are other layer 2s like Liquid, which Blockstream is a technology developer of, and a number of exchanges, including Bitfinex, who you work for, are members of that kind of sort of corporate peer-to-peer network, if you like, in terms of the block signers. But it's, de facto permissionless for people to transact and issue assets and so on. So it's very Bitcoin-like. In terms of the scripting capabilities, it has various extensions, so a few more advanced scripts, covenants, for example, and confidential transactions. And so in particular, for this topic, the technology we've been working towards and is in market now is the ability to make trustless non-custodial limit orders on a central limit order book operated by an exchange. And a good example of that is SideSwap. So if people go to sideswap.io, they can see an order book for a range of assets, and you can even start your own markets in assets just by clicking around. There's kind of no kind of sign-up details for that. And then what actually happens when you want to take an order or place an order is you use your smartphone or your desktop, you use the SideSwap app, which has the private keys. And we'll soon have hardware wallet integration with Jade as well, and hopefully other hardware wallets soon after. Well, definitely a couple are in the works, but more to follow. that you would basically sign a limit order, and the limit order would either be broadcast into a distributed exchange, like there is Sideswap, but there is also TDEX, which is a bit more decentralized, and XDEX, which is a company sort of providing market using the XDEX tech, and BitMatrix, which is an automated market maker. And all these work using trustless atomic settled limit orders. And so basically what's happening, if you think about it, is if you've got some Tether or other stablecoin on the Liquid network in a hardware wallet, and you want to buy some Bitcoin if the price falls to, a little bit from where it is at the moment, you sign a transaction saying, here is, let's say, $16,000 a Tether, and you put an address where you'd like to receive the Bitcoin if the price gets to that level, and you sign it. So it's kind of half-signed transaction. You either send it into these decentralized things like TDEX, XDEX, BitMatrix, or you place it on Sideswap's order book, and when it matches, the buyer, the taker, will add the Bitcoin and put the address they want to receive the Tether that you're buying it with to, and they sign it, and the combination becomes a transaction that's now fully signed, and it just gets dropped onto the Liquid network. In the case of Sideswap, they take a commission as well, so it's kind of three-way transaction. And there's no reason that kind of technology can't be integrated into regular exchanges too, because what they can do is they can mix custodial trades with non-custodial trades. All they do is they use some of their hot wallet to act as a taker or a maker corresponding to client orders against that order book, right? And then arbitrage will take care of the rest. And that basically allows people to trade without taking custodial risk. And the reason is that what you've uploaded to an exchange when you place this limit order is not, the Bitcoin or the stable coin. It is a signed transaction where anybody can take the stable or the Bitcoin, but only if they pay it into your cold wallet the asking price, right? So I think that's in my view, that should be the future. And I'd like to see, in terms of talking about, what venture capitalists could do, they could allocate some funds to actual innovation that, uses the promise of blockchains, of, trustless things, of actual smart contracts that do things in a secure and trustless way. Now, other smart contract platforms have, scripting capability, but they appear to be unsecurable because they are extremely poorly architected. Whereas, what Liquid does is use the Bitcoin architecture, which is a security-first, robust kind of technology that doesn't drop, the equivalent of JavaScript or ActiveX in an interpreter into the core of the protocol and state and all kinds of other bad things. So I think that's the future, and we have been talking for a while now with some key exchanges about integrating that technology. So I think that could be a kind of sea change technology, kind of like, historically before Google came to prominence, there were previous era top tier search engines like Alta Vista. Was a while back, but they were the go-to. There was another search engine before that. Alta Vista came along, and it was just miles better. So everybody dropped everything else and used Alta Vista, and then Google came out, and they were significantly better than Alta Vista. So everybody dropped Alta Vista. It's like a footnote in history now, right? So I think this moving to dependable, non-custodial trading tech can fix this problem, and should have been where the investment focus was all along. So I think the investors, to my mind, are under allocating towards general innovation and over allocating towards early liquidity, altcoin side pockets and things like that, because they can sort of make money early, whether or not the project succeeds. And that leads to a cheap money situation where you get, speculative bubbles and failures like Luna. It turns out incentive matters. Now, the market figured this out, over the last 100 years, from early last century, stock scams and things, and introduced, market rules and regulations, and also honed investment contracts, so investor rights and board oversight, audits, accounting rules, all of these things sort of are organically evolved things. And I think people, in the crypto world, many of who are young or inexperienced in any of these domains, it's very easy for people to get overconfident and think that, well, that was then, that's old stuff. We're going to do it anew. We're going to rewrite all the rules and do it again. But I think the mistake is in not realizing that things that evolved organically or evolutionary, like biologically, can be very clever. Basically, the things that evolve biologically can arrive to solutions which are hard to arrive from first principles. And so if you tear up the rule books and start again, you're probably going to repeat all the mistakes and end up in the same situation, in the same pattern that you could have moved forward with, or in some, new interesting variant. But a lot of money is going to be lost in the meantime in, a repeat of previous centuries' stock bubbles and scams and things. And so that's what we're burning through now. So, I view the FTX thing as significantly related to that, because they, their balance sheet, Alameda's prop and FTX's prop balance sheet was published, and it's full of like illiquid altcoins. It doesn't really look like an investment thesis. So, and they were also, involved in creating altcoins, creating artificial liquidity, and particularly Sam is somewhat infamous for a discussion, like a podcast discussion or something with some mainstream media journalists talking about, money in a box, like a sort of abstract concept of what these altcoins are, or ICOs are. And it just basically said, there's money in a box, and the box doesn't make any sense, but people invest in it, and then other people follow the rise in price. And sort of basically describing a Luna-like phenomena. So yeah, I think that is leading to sort of underfunded people who are on a mission to do innovation, and overfunding for, ultimately unsustainable things which are hyper incentivized, and so end in tears, basically.
What are the other innovations for that? Is it just limit orders, or are there other applications you guys are working on as well?
Well, I mean, it's actually, a lot more than that. So, in fact, in a conventional financial world, most securities contracts are covered by like 12 different contract types, like options and so on, right? So, and there's a long term of more exotic stuff, but and that's largely the case in the Bitcoin and crypto markets too, right? There are options, there are futures, and so on, and leverage. So it's Blockstream recently published some new development of trustless options. So the example is Bitcoin versus USD stablecoin, but it could be options between anything. It could be options between, Bitcoin and something like a share represented in this format or something like that. So, and other kinds of things are possible, right? You have covenants in liquid, and so the point is you can do, and the options are tradable, right? They're tokenized, but they're collateralized, tokenized, and trustless. They don't even rely on a price feed. You don't need a price feed to implement those. So, that can also be done in a trustless way. So I think it's all possible. Just have to get people, a challenge in working with exchanges typically is that they are too busy integrating altcoins to, follow up or follow through on integrating something that will reduce risk.
Well, that's part of the business model too for a lot of exchanges is listing fees.
Yes, certainly. So I mean, we're describing, effectively a sort of systemic effect, right, rather than an intent effect. But nevertheless, it's the case, and some exchanges do much more reinvestment into the Bitcoin ecosystem. So, I consider Bitfinex to be one of the good ones in that regard. One of the earliest exchanges to integrate liquids in a big way.
And Lightning.
Yeah, and integrate Lightning. There are other exchanges that integrated Lightning, and Liquid. Some of them integrated, but sort of seemingly begrudgingly after being kind of hounded on social media for multiple years and having, dozens of prominent Bitcoin proponents active on social media, and yet, and if you're a member of those exchanges, even if you don't use them, you get, their daily, we've integrated X, Y, and Z altcoin, we've delisted X, Y, and Z altcoin, and yet evidently they had no time to integrate Lightning. And some of those, we literally contacted them and said, look, we'll fly a developer to your site, it'll only take a day or two, we can do this. And like, nah, not interested, basically, right? So, that is, they might say that, I think it's fair to say the exchange space is, competitive, and that is why exchanges will support altcoins. I think, partly to be a one-stop shop, that some subset of their customers want the capability to trade multiple things, right? And so if they go to one exchange and they're like, well, we're Bitcoin only, that works for some people, and props to them for doing it. But for others, it could cause some of their customers to move to another exchange, and it's a competitive space. But I think nevertheless, it's incumbent on exchanges to, move the state of the art in terms of security forward and to reinvest into, ultimately what it's all about, which is like none of this would exist without Bitcoin. And most exchanges, the lion's share of their revenue is actually Bitcoin to this day, despite, feeling the competitive need to pay lip service and support things. So, the exchanges are actually typically sitting on a fairly, the moderately to highly successful ones are sitting on, pretty healthy income and revenue stream. Like that clearly is the case when people have, multiple thousands of staff, for example. And so, to integrate some of these things isn't even expensive. It's just, a sort of commitment to reinvest, right? So anyway, I think perhaps, one kind of positive side effect of this situation, to my mind, is to see some more exchange commitment to actually integrating and genuinely benefiting from the, trustless value of blockchains. And, that is why we started working on Bitcoin layer 2, like Liquid. So, we're happy to talk with exchanges who actually want to start doing it, and also happy to talk to investors. There are a number of, obviously there are a large number of Lightning related startups. So there's an ecosystem of investors that are relatively Bitcoin focused, early stage and mid stage, even some late stage now. And that's good to see a later stage Bitcoin centric investment coming in. It'd be good to see some commitment to Bitcoin related innovation. And there's a collection of investors on Liquid. And so the number of Liquid related startups on the fintech side, like Stocker, and on, scripting and trustless exchange like Sideswap and TDEX, XDEX, Bitmatrix, and so forth, right? So there's certainly lots of organic things happening, and some of those are self-funded, some have early or mid-stage VC funding. So, but it would be good to see some investment into that kind of sort of security-first innovation that could actually move things forward for exchanges, because I think the other so-called smart contract platforms have pretty much categorically proven that they are unable to deliver security. So I think in the early days they could be. In the early days, you could be forgiven for thinking, and I assume that many investors did, that, oh, well, they have some security problems now in Ethereum and clones and other competitors, but they will fix it, right? Early stage things have teething problems. A lot of money's been invested in it, that they would fix it. But actually, it seems to be getting gradually worse. They've been reliably losing, even individual chains, $1 billion a year to hacks and, basically defects in the architecture, and they're not improving it. Like, they think they're improving it, but what they're doing is they're piling more complexity on top. And I've talked with some of these people, before they started their coding, or more recently, to say it's a mistake to build complexity on top, to build complexity on top and to have a complex base layer or any layer. And so there's actually a observation called Gould's law, which states, quote, that a complex system that works is invariably found to have evolved from a simple system that worked. A complex system designed from scratch never works and cannot be patched up to make it work. You have to start over with a working simple system. And so my view is that that is exactly what's gone wrong with these other smart contracting platforms in the works, in the system, right? They started with a full interpreter, with state, with race conditions, with minor extracted value problems, and unsecurable languages. There's a whole area called language security. And so, their inclination is to see that the system has a problem, and then they make a roadmap to sort of repair it by adding more complexity on top. And, what Gould's law is saying is actually, you've already failed, you just haven't realized it yet. What you need to do is restart, start over, throw it away, start with a simple base layer, and then get a robust base layer and build controllable modular behaviors on top. And so, that's basically Bitcoin's design philosophy. It's a Linux design philosophy. Most networks are layered. Most successful systems have these properties. So, how you can arrive at that is you can have genuinely smart but inexperienced people who get enthusiastic and they don't respect complexity. Keep it simple, stupid is a very important maxim.
Yeah, I was going to say that, Solana looks like it's in a lot of trouble. And we mentioned the 16,000 wrapped Bitcoin earlier that, might be gone, might have lost access to. So I was wondering, do you think that highlights the liquid value proposition, especially from an asset issuance perspective, whether it's issuing transfer restricted assets like STOs or liquid USDT?
Yeah, it's certainly a very simple and, to my mind, elegant system for asset issuing, which is that all the chain sees is, firstly, to issue assets. Assets are natively supported, so they're cleaner than the other platforms typically. And as the issuer of an asset, you get an asset issuer's key, which is represented by a reissuance token, and you can then create more. And in terms of the sort of asset transfer rules that sometimes come in, because if something is a security, the issuer or the fintech provider that is operating parts of it will need to restrict its access to people who are accredited investors or live in a certain set of countries and so on. So in the liquid case, this is an opt-in feature. It's called AMP, Asset Management Platform, and all the blockchain sees is a multisig. And the second signature is the equivalent of a share registration agent. So, in Liquid, there are a few of those, but the one is Stocker. And so, they handle the KYC. They have visibility into the transfers, and the experience in a wallet is, if you try to send it to somebody or try to receive it without having enrolled on Stocker, and it depends on each asset which registration agent the issuer chooses, then it will be blocked. It won't be possible at a wallet level. But in terms of the network technology, the base blockchain isn't aware of any of this. It just looks like a multisig, right, where one party is selectively signing or not signing. And it's a 2 of 2 multisig. So there's a simple way. And it also has, some interesting financial privacy advantages with confidential transactions. So the confidentiality hides the value of a transaction from the network so that only the sender and a recipient by default know how much was transferred. And that extends to assets as well. So the network can't see which asset type. And it also extends even to the issuance. So when you issue a token, you can choose to make the quantity of the issued tokens transparent. That means the original issuance and all subsequent issuances are not confidential. They're in a clear text, and then you can go on Explorer and you can see the amount in circulation. If any are burnt, you can see that. So you can see the running balance. And so Tether is issued on Liquid, and it uses that model, right? It uses a transparency model. But there are other ones that don't. So for example, Bull Bitcoin has a different kind of stablecoin, which is a kind of Canadian dollar voucher for buying, redeemable only for buying Bitcoin. So it's kind of a neat thing. And that has a confidential issuance. So only Bull Bitcoin knows how many there are. So that's kind of a neat thing, you know. So they did an initial issuance which was confidential, but the network is enforcing that limit, and they can reissue more, and that will also be confidential. How many they issue, and the burns you can burn as well. So it's So I think it's a simpler, robust way to do it. It's supported by, you know, multiple hardware wallets and multiple software wallets at this stage.
What about the mining industry? I wanted to ask you about that. You know, hash rate is up at the top end of the historic range. Price is now at the bottom end of the 2-year range. What about miners? Do you think they're the next shoe to drop with Bitcoin now down to 16,000?
Yeah, some of the miners have taken on, well, so, you know, mining is a kind of commodity activity. So there are, you know, individual miners, small company miners, large company, public and private miners, and they're also all competing in this open market. And so, you know, what they're competing on ultimately is the efficiency of their miners and their cost of operation. And so, you know, and there are a range of efficiency miners in the market, ranging from about 35 joules to 25-ish joules. And so, you know, you can calculate in any day, given the prevailing hash rate and market price, what the electrical break-even is. And, you know, if their operating cost is higher than that, then they have to stop. You know, they will, you know, buy some new miners if they're doing well. If they're not doing well, they might shut down. And so, you know, people with cheap power and 35 joule miners probably still all right. People with average power, but 25 more efficient 25 joule miners probably doing all right. People with higher cost power are probably having a bad time. And then another phenomenon we've seen in this cycle is the rise of institutional lending to miners. So it seems that a number of the public mining companies, and we don't always have visibility into the private ones, took on leverage in the form of borrowing dollars against ASICs to, you know, pay the power, keep as many of the Bitcoins as they could, sort of defer selling Bitcoins that they're mining, or also borrowed against Bitcoin that they had on their balance sheet, both of which are correlated. You know, when mining profitability is down, the cost of new miners is down. There is now an oversupply of miners, so the price of miners actually fallen faster than the price of Bitcoin, actually. And so, you know, some of the institutional lenders have publicly disclosed that they had to work with a borrower to restructure a loan. Some of the borrowers have sold their miners or, you know, raised money in other ways to reduce their debt ratio. And of course, some of the miners have sold down their Bitcoin reserves. So, you know, where last year...
I think that's what the market is most worried about.
Yeah.
Or is it they'll have to sell Bitcoin?
Well, I mean, I think that probably most of that has already passed, you know, in the sense that you can see for the public companies the reserves, and some of them are quite low on reserves, so that they can't sell what they don't have, basically. So that's one protection. And I think, you know, while the profitability, which you can calculate or look on calculator sites for, is down, it is not as bad as it seems, because it's partly a self-correcting system due ultimately to the Bitcoin's difficulty adjustment. So what will tend to happen is, you know, if profitability stays low, the people with the most expensive power and or the less efficient machines will switch them off, and the hash rate will fall. And so the Bitcoin mined per terahash will improve the profitability a bit. And so, you know, it doesn't fall as fast as, you know, the baseline metrics would lead you to assume, because it's a dynamic system that adapts.
One last thing I wanted to ask you about. CZ tweeted today about a recovery or a bailout pool to help good companies that maybe find themselves in a bit of a liquidity crisis. They already have a huge VC fund, so which he actually pointed to in that tweet. What do you think of this as a solution?
So I'm not drawing any analogies between Binance and FTX, but just to observe that is actually what FTX was doing since the Luna collapse, right? Offering to bail out companies and actually bailing out companies. So now I think, FTX is Binance is a very different business. As far as anybody knows, they're not doing prop trading, etc., right? So, but I think one thing you can observe is that there's a difference between making an announcement and delivering the capital. So there's a bit of a history in this ecosystem, not just with Binance, but with some others, that they will put out large number announcements. Typically the number is $500 million. That's a favorite go-to number. And it's going to be for something. It's going to be to buy distressed ASICs, like buy cheap ASICs, start a fund. It's going to be to bail out companies. It's going to be to offer lending facilities like Bitmain. It's not Bitmain. Yeah, I think Bitmain offered that, talks about that. And, that sounds good, and it buys them, market recognition in a sort of similar way that FTX did, right? Which is, they look to be putting to work large amounts of capital, which is an indication of success. But the challenge is that it's much easier for them to do that and quietly not follow through, or follow through 10 times smaller. And so we don't know how much money they actually have or if they're inclined to spend it. It's a down market for them too, for all exchanges. And in a sideways or like a low point in Bitcoin's price, typically the exchange volumes are down. So, I think some companies are insulated because they have multiple lines of business or are lean. So,
But that's naturally when you'd expect consolidation to happen, right?
It sounds good, but how much can they deliver through on? And maybe other parties will participate. Maybe VCs can do that kind of thing. There are always people in market interested to buy distressed assets. But when people buy distressed assets, they're looking for a discount, right? They're looking to buy the shares at below, their most recent raised price or something, right? Whereas what CZ seems to be talking about is, providing liquidity like loans for businesses or something, which, somebody could do, but there's less upside in that as compared to, buying a stake in them, for example, right? If you actually thought it was a good business. But, that's a different line of business. Some people are interested to lend money, others are interested to buy a stake in a company, and there's different risk profile. And of course, there are hybrids where people will, lend money with a warrant kicker. So it's kind of, they get some shares over time as a alternative to interest. So have like a lower interest rate and warrants.
We've taken up a lot of your time today. I want to, end on a positive, on an upbeat note. What are some things that you're looking forward to over the next 12 months? You think maybe positive things that can develop in the industry?
Well, I think the Lightning metrics are looking good. Liquid's kind of organic growth is looking good. And I also think that, some people are feeling dismal in the market, but I'm I'm feeling fairly bullish. Of course, you have to take that with the knowledge that I'm a bit of a permabull, so I'm always bullish.
I was going to say.
But the reason, I have a reason which is, similar to what actually Kevin O'Leary, Mr. Wonderful, said on video a couple of months ago, which is that, most bear cycles, and he was talking about the Bitcoin market, but I think, here's a wider market experience, applies to other markets too, are sort of punctuated by a bottom forming after something big fails. Now, ironically for him, he was already an FTX investor, when he made those comments, so obviously he wasn't expecting FTX to be that bottom of the market indicator, but I think it's correct in the sense that you can form a better restart for the price when there aren't hidden air pockets of over leverage lurking out there, right? And so a drop will already since the lunar impact on the market is already less leveraged, right? So there are less Bitcoin on exchange to buy since then, and the prevailing margin lending rates are lower, and the overall metrics that you can look at in exchanges of margin lending rates, the amount, the size of margin lending is lower. And so I think this FTX situation will just increase that. So more people will take Bitcoins off exchange, so they're less tempted to leave limit orders or start tinkering with trading. And so if there's a supply squeeze there, and leverage will go down further because people they learn lessons when they lose money. Now I think the really unfortunate side effects of this is that probably a lot of the people that lost money, presumably will ultimately lose money in the FTX situation, did not realize they were exposed. They weren't even trying to do anything leveraged. They were just, on the exchange, or they were using the services of a company that was somehow indirectly exposed to that exchange, by having treasury, some of their runway, the treasury assets on exchange, or, was sort of indirect, using services of a company that's impacted in that way. So that's really unfortunate. But, to come back to what I said earlier, I think my personal suggestion for how to protect yourself from such outcomes is to just keep 90% of your coins cold stored, or 100% if you can. But, if you are sort of philosophically interested to tinker or play with and do a bit of trading or market activity or take positions, I think trading is useful because people who are cold storing are not setting the price. The people who set the floor are the buyers of last resort in Bitcoin. So you are providing a function, and we need, in a way, a lot of the structural problems with Bitcoin's deep cycles is because, it sounds paradoxical, but because Bitcoiners are too all in, So when they see a price that they'd really like to buy, they have no money. And you're not setting, if you have an expressed, if you have a desire to buy, but you've used up all your money buying before, then the market doesn't hear you. You're not part of the price form. I mean, yes, you don't have, so on a personal basis, you don't have the money to buy more, but in terms of the market effects, all the people in that position, the market can't hear you. The way you speak to the market and contribute to the price formation is by buying, right? By trading in the market. And if you've taken yourself out of that, you're not setting the price. So effectively, and a lot of trading is, as I say, wash, not in the derogatory sense of like artificial, but in the sense of just people like micro speculating on a price movements, day by day, hour by hour. And so that's not really price formation. It's just sort of short-term speculating, kind of market making or something. But what actually sets the price is somebody, is the group of people that will step into the market and buy, Bitcoin in volume. Of course, it's weighted by volume, but there are people, traders who've been around for a while who take something off the table in a bull cycle, so they've got dry powder, and they will take large positions at times like this, and they basically set the floor. So I think it's worth bearing that in mind. But like for personal risk, like cold store or use the trustless limit order tech like Sideswap. Go look at sideswap.io. Look at the demo videos. Try it out. Get set up. And if you are going to use lending products, try to use ones that have some kind of proof of cold storage like HODL HODL and some of the others have proof of reserves, or you can see your collateral sitting there, and in some cases you have one of the keys, so it's a multi-signature. So you wouldn't have the situation like with FTX with that, or potentially companies that may yet turn out to be affected by FTX in the lending market.
Well, I think that's good advice and a good place to wrap it up. And hopefully the next time you join us on the podcast, we won't be doing another postmortem in 3 or 4 months' time. So hopefully we've got the worst of it behind us now.
Well, onwards and upwards, right? So we've flushed the market has flushed out some leverage. There are less coins on exchange, and it's the markets can be tough. It's kind of like survival of the fittest, a biological event. But basically, people who make bad investments lose money, and so they have a smaller voice in the market going forward, or they leave the market ultimately. So that is part of the efficient market hypothesis that people who are better at allocating assets do well. The short-term problem has been profitable for some venture capitalists to effectively misallocate capital into sort of projects they don't necessarily believe would succeed, but that they get early liquidity in, and retail listings on Coinbase and others to exit their positions. So that that left unchecked would sort of just keep going, right? I mean, if they can make money for their investors, they can raise a larger fund and do it again. And it's not really helping, anybody, like humanity or capital allocation, building of actual value in products and services. So, I think that you could view that as another beneficial side effect of this. I view the Luna and the FTX things to be largely about sort of incentive failures and over leverage and this kind of over incentivized Ponzi-like activity, right?
Yep, that always has to end in tears. And we have to have a brush fire to clean it out. Yeah. All right. Thanks for your time today, Adam. It was a great conversation. Really appreciate it.
Thank you.